Your market news now. U.S. stock futures are down as the military tensions in the Middle East lifted oil and treasuries. Brent crude rose by as much as $4 a barrel at one point and last traded up around $3 at $87.67 a barrel. The surge in oil prices reversed last week's downward trend, the largest weekly decline since March, in which Brent fell about 11% and WTI retreated more than 8% as a darkening macroeconomic outlook intensified concerns about global demand. Gold is also in demand right now, rising up 1% to $1,850 an ounce. Investors' attention is now turning to Thursday's September consumer price data, which could challenge expectations that the Federal Reserve will not raise rates further. To give us more perspective on the markets, we are joined by Riza Ismail, who is the head of bonds at Prescient. Riza, thank you so much for your time. I mean, given the picture that I've just outlined to the viewers, we're still going to be talking about bonds at least for a while. What do you make of the dynamics that we've seen in the bond markets? And I'm curious to know whether you think the worst of it is done.
Thanks very much, Nastasia. Always a pleasure to be on your show. Yeah, I think it's quite what makes it quite challenging to offer an assessment as to whether the worst is behind us is if we take a step back and we look at our assessment of South African bond yields, then it's for a long time been our contention that the price determinants of South African bond yields are largely global in nature, and this time being no different. And we think that the recent conspicuous sort of weakness we've seen in the bond market takes its cue sort of chiefly from the US bond market. And what has happened there in turn has been an element of repricing and recalibration of yields higher to take into account that we in fact have got a US economy that is in fact not capitulated and is continuously sort of surprising to the upside. So real yields have marched higher in the US. That's got a knock-on effect on bond yields the world over. And that largely has happened because the consumer has proved to be a lot more resilient than initially anticipated.
What do surging bond yields mean for the Fed's efforts in trying to tame inflation?
So the interesting thing is that if we actually sort of try and disaggregate or look under the hood of what's sitting behind the bond yield, so we can think of the US 10-year bond yields as consisting of sort of a real yield component and an inflation expectations component. For the past 2 years, the focus has largely been on that second component, the inflation expectations component. But what is interesting this time around is that it's largely been driven by real yields moving higher, real yields getting weaker as a component of that 10-year bond yields. And the reason for that, in turn, related to my first point, is that the cost of capital or the opportunity cost of capital needs to be recalibrated higher to take into account the stronger economy that we've seen up to now in the States, exceeding expectations, that is.
I'm glad you brought up the idea of this time around, and I don't want to give away your age here, but let's tap into your career memory. Have we seen anything like this in the past? Are there any similarities or differences here?
I think similarities is that I think that if you think of South Africa as being almost like a risk on carry trade destination, then the fact that you are seeing yields being weak at a time that global financial conditions are also tight, I think that is quite similar to episodes that we've seen in the past. I mean, what is different this time, though, is that this is occurring at a time that sort of aggregate demand out of the US has actually been fairly resilient. So South Africa, normally what happens is if the aggregate demand is quite strong out of the US, the dollar behaves like a counter-cyclical currency, and emerging market destinations like South Africa usually do well. Being a small pro-cyclical open economy like South Africa usually does well. So it would normally, from that perspective, be an environment that is quite positive for bond yields. However, we're seeing that not actually being the case this time around.
If we focus in on the higher for longer narrative, does that mean that the South African Reserve Bank will have to push out its interest rate cut cycle to align it with the US?
I very much doubt that, and that would certainly not be our base view. And what adds the level of conviction to that view has been the Reserve Bank governor himself coming out to say that they would not specifically defend the currency per se. In other words, what he means by that is that they will conduct monetary policy in accordance with their primary mandate, which is to achieve price stability. So in other words, if inflation settles nicely near the midpoint of the band, that is between 3 and 6%, so settling at around 4.5%, and there's no real step change in inflation expectations, then there's no need for the SARB to maintain a very hawkish and restrictive policy stance for longer than what is necessary. So that is almost exactly what the governor has come out to say. If it were to be the case that they were simply looking to defend the currency, then what would happen is that they would actually maintain policy rates at a level that maintains current sort of interest rate differentials between ourselves and places like the States. But he's in fact saying they will not do that, and it's also our base contention that that will in fact not be the case.
In an environment like this, are you cautious, or are there aspects of the fixed income market rather that you are bullish on?
I think a little bit of a two-sided answer. So definitely, if you think about the kind of yields on offer, 13% at the back end of our yield curve, I mean that translates to roughly about an 8% real yield. So that is almost like an equity-like return signature that the South African bond market is offering, which is something that should ideally be locked in. But I think that the element of caution here is almost that with the South African bond market being so indexed and so tethered with this process of policy rate normalization in places like the US, you have got this additional feature that you have got quite heightened volatility in the South African bond market. So that sometimes can lead to almost like capital losses at a time when the asset price of the bond itself is quite cheap. So you have high real yields, but you also have heightened volatility. So you almost have to trade off those two different attributes depending on your particular needs at a point in time.
Riza, thank you so much for your time this afternoon. That is Riza Ismail, who is the head of bonds at Prescient. And looking at the oil price right now, 87.66, and of course the rand trading at 19.39. We are seeing the JSE firmer, and that has been led by the precious metals as well as the resources. That is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.